All right, welcome in those of you that were already on. We're going to start here in just about 1 minute, and we'll give people just a minute to join. It looks like a good number have already joined in. I'm surely see a good number more join in the next minute or two, but I'll go ahead and start and introduce everything. So, hi everyone, and good morning. I want to thank each and every one of you for joining us today for our webinar, HSA Hacks for Smarter Healthcare Spending. Today, we will discuss the critical role of health savings accounts, or HSAs, in tackling the rising healthcare costs that both employers and employees face. We do have the Q&A feature available, so you can submit questions through that option. And if there's time at the end of the session, those questions will get addressed. But you can also submit any questions to us via email at wealthteam@yoursummit.com, and I will display that email address near the end of our session today. Now, I would like to introduce our panelists joining us for the discussion today. First, we have Matt Clarkin, who joined UMB Bank in 2024 as a Vice President of Business Development for their Healthcare Services Division. Prior to joining UMB Bank, Matt was the co-founder of Access Point HSA, which is an independent consulting firm that assists financial service and employee benefit firms to maximize the growing opportunity available through HSAs. Access Point accomplishes this by offering customized information on the HSA provider marketplace through its subscription-free online database, HSA Vista, by educating and training through its comprehensive DALBAR-approved Certified Health Savings Advisor Designation Program, CHSA, as well as providing customized materials and supporting financial firms. Also joining us today, we have Brandon Schultz, who is the Director of Operations for Investments at Summit. Brandon has nearly a decade of experience across investment, banking, and accounting industries. With this experience, he's able to bring knowledge to clients in multiple areas of their financial lives. Brandon is client-focused and values educating America's workforce on how to improve their finances and help them achieve their unique financial summit. And now I'll pass it over to Brandon to get us started.
Perfect. Thank you, Matthew. Appreciate it. And really thank you all for joining during what is, as we all know, probably the most busy time of the year for everybody. A lot going on. I know a lot of Christmas parties. I've got a Christmas party to go to tonight, so a lot of things going on. Everyone's trying to fit everything in for the end of the year. So thank you all for joining. And I'm really excited to cover a topic. We were just kind of talking in the green room about how this is a topic that's probably top of mind for people on the call, as it is the kind of time of year that a lot of people are enrolling in health benefits. So hopefully this presentation is informative. I will say it's a topic I've been learning more about, and really how beneficial it can be also as a retirement savings vehicle, which I know is something that we're going to touch on. We do have quite a bit of information to cover today, and we try to keep these not taking up a full hour of your day, especially during Q4. So really, Matt, I am going to pretty quickly here turn it over to you, and for lack of a better term, wind you up and let you go.
All right, thank you, Brandon. Appreciate everybody being on the call today. Education sorely needed with regards to health savings accounts, so I give you all credit for being on here today. We've seen over a period of time that we've actually lost some ground in the understanding of health savings accounts. This was from Bank of America. They did a study of employers and employees in 2019 and in 2024. As you see here, the number of people who actually understood the HSA actually went down over that period of time. So we've lost ground. So doing events like today is really helpful. So I appreciate Summit for having us on here today to go through some information. And there'll be a good amount of information we're going to go through in the next 30 minutes or so. Provide some details with regards to health savings accounts, but in many ways also the goal is not just the 101 and the characteristics of the HSA, but also to kind of change your perspective with regards to what that health savings account can be and should be for people when it comes to paying for healthcare costs today and in the future. And so just one last thing with regards to that education. Here we see that Bank of America, these are basic things that they were asked, these three things with regards to HSA availability through a high deductible health plan. And these are the percentages of people who are able to answer these correctly. So as I said, there's a lot of work for us to do, and today's a good day for it. So just a quick, like I said, want to give some 101 or the basics on health savings accounts. I'm not sure who's on the call. So for some of you, probably for many of you, this will be review, but just to go through the basics of the health savings account. When we talk about a health savings account, it's the bank account, the HSA, tied to an HSA qualified health plan. Now, those health plans are considered or called high deductible health plans. Now, I don't know if there's a marketing hall of fame, but if there is, whoever came up with the idea of the high deductible health plan is not going to be inducted, right? It's not exactly the term that everybody should be using, because you could very easily call it a lower premium health plan, but it's a high deductible health plan to be qualified for a health savings account. And the idea with regards to that is that with the high deductible health plan, just like your regular car insurance, if you will, the individual is making more choices because they have the higher deductible up front before the insurance kicks in. That health savings account, the savings associated through the tax advantage of the HSA, helps make up for that higher deductible. So what is this qualified high deductible? In 2025, the minimum deductible, that floor, is $1,650 for an individual plan, $3,300 for a family plan. And then the ceiling, the maximum out of pocket, is $8,300 or $16,600 for a family. Now, these amounts that I'm showing you here are the minimum and maximum. So the minimum floor and the maximum ceiling set by the federal government. The health plans themselves will be all different, and most likely will fall somewhere in between these areas. But that's what the federal government calls a qualified high deductible health plan to be able to be eligible to contribute to a health savings account. So the major characteristics of this HSA, there's 6 that I want to go through with you. One is that there are tax preferred contributions from federal and in most likely state, if there's a state tax. There's only, I believe, New Jersey and California that do not exempt HSA contributions from their state tax. But right off the bat, you have the savings from federal and in most cases state. Number 2, pre-tax contributions. If the HSA contributions are made through pre-tax contributions through payroll, the individual also saves on the payroll taxes. And that's for both the employer and the employee saving the FICA, so 7.65%. So right off the bat, federal, state tax, and payroll tax is savings for both the employer and the employee. No income limits apply. There are some accounts where, depending on your income, you can contribute to certain things. With an HSA, there are no income limits. And as a matter of fact, as you see in number 4, contributions do not have to come from earned income. And then also, when it comes to number 5, you've got the money going in tax-free, and you also have it growing tax-free. So to be able to earn interest through either investments, through interest or through investment, that growth is also tax-free. And the HSA is owned by the individual, so that HSA is portable. So if an employee or an individual has an HSA with their employer and they move to another employer, they're able to take that health savings account with them. Now, let's say they move to another employer that doesn't offer an HSA qualified plan. They can still use their HSA in the same way in which they were able to when they were under a high deductible health plan. They just can't contribute any more money into the HSA. So you've got that portability, which is so important as well because it's your individual account. And this is a tax treatment comparison. So you see in the middle, we see the 3 different plans that we're comparing, the Roth, the 401k, the HSA. Anywhere you see the the powder blue, if you will, that's a taxable event. So with the 401k, the money's going in pre-tax. You're not paying tax. On the way out, it's taxed. And there's a required minimum distribution, that RMD, meaning the federal government, Uncle Sam saying to you, listen, I let you put the money in tax-free, and I let you hold it all this time, but I'm not waiting any longer. You're going to have to start taking some money out of there because I need to get my piece, right? So that's the required minimum distribution with that 401k. With the Roth, the money's going in after tax, growing tax-free, and because the tax has already been paid, no required minimum distribution. It's only with the health savings account where the money is going to go in tax-free and come out tax-free for a qualified medical expense. It's the only opportunity you have to do that with regards to these long-term accounts that you're able to build up over time. And the fact is, with the HSA, no requirement distribution because Uncle Sam doesn't have any money coming to him unless you use it for a non-qualified medical expense. As we'll talk about later, there's really no reason to use it for a non-qualified medical expense because we're all going to have a good amount of expenses in retirement. So we'll talk about that in a little bit.
This was actually, Matt, probably my favorite slide, because I think it really shows how incredible this is as a savings vehicle, as compared to other retirement savings vehicles, especially for me as I'm, doing a lot of education about Roth versus pre-tax and 401ks and looking at Roth and IRAs. Everyone's always looking for the best tax solution. And this is just a great opportunity for tax-free growth. We've heard it said as triple tax advantage because it, goes in tax-free, the money grows tax-free, and you pull it out tax-free. And so it truly is, I think, just that unique savings vehicle because of the triple tax advantage. And I'm kind of looking forward to more of those slides in the future that talk about those expenses that you can pay out. Because I think a lot of people look at HSAs as short term and like, I'm paying for something soon, but that's, just not the case, and you can be really creative with them. So I do love this slide.
Yeah, I think that's what I said earlier with regards to going over some of this detail as to what these HSAs are, but also to, I think equally importantly, to change your perspective as to what that HSA can be in the long term. The idea that, hey, listen, this can be your 401k for your healthcare expenses, right? And I want to talk about why that's so important because it really is a health savings account. It's not a health spending account. And again, with the HSA, you have the flexibility to use it however you choose. When it comes to your contributions, even you make your contributions, unlike some accounts like a flexible spending account where you declare the amount you're going to contribute in the beginning and then you're stuck with it. With an HSA, you make your contributions as you go based on the situation that you're in. So, you have a plan to put in, $50 for every pay period. And then all of a sudden you wake up one morning, the water tank went, well, now you're gonna change that, right? So you have the flexibility on putting the money in, but then also with regards to the flexibility taking it out, meaning, hey, right now under my circumstance, I need the tax savings today. However, if I can hold off and I can push back and build up this balance over time, it's going to help me in the long term. And that's the idea of helping change your perspectives. But as you said, Brandon, the triple tax free makes it a really powerful tool in the long term. So how much can you contribute in 2025? And just for, I know we're at the end of the year here. So in 2025, it's $4,300 for an individual. If you're covered under an individual plan, it's $4,300. If you're covered under a family plan, it's $8,550. Just so you know, in 2026, the individual amount's going to go up to $4,400, and the family's going to go up to $8,750. Now, there are catch-up contributions available too. So if you're 55 or older, you're able to make $1,000 contribution into the HSA as well. So here on the right, we have, in both these cases, we're assuming 55 or older, individual 5,300, a married couple, both 55. Your maximum contribution is $10,550 for 2025. And this is a comparison looking at the HSA versus the FSA versus the HRA. And these are all, excellent tools for people to use. With regards to the health savings account, however, I think if you look as we go through this, you'll see the power of that HSA. The first, right off the bat, is that anyone can contribute to an HSA. the employer, the employee. We say other. I used to, parents can do that for children. We'll talk about that in a little bit. We talked about the maximum contributions. A couple things to point out here is that the third row down in white, who owns the account? It's really only the employee owning that HSA versus the flexible spending account, from the idea that there's no maximum rollover amount that you can have with an HSA. You can roll over those balances year after year, grow it tax-free, where you can't do that with the flexible spending account. And with the HRA, it's simply a reimbursement account. So it's only that HSA that's going to give you the flexibility to build up this balance over time.
And I think we're talking a lot, Matt, about the accumulation of the HSA. But one of the first questions that really came to my mind as I was going through this and looking at HSAs and how they can be utilized is you talked about RMDs. RMDs aren't required, so it doesn't seem to be like there's a point where you have to withdraw all of the money. But also, if I do leave my employer and I have a balance and I'm, maybe retiring, so I'm not going to another employer where I can carry it over, how do those get rolled over? And then kind of the last part of that question is, thinking worst case scenario here, what happens if I die with an HSA balance?
Right. So with regards to the retirement, the first one, with regards to retirement, you can't contribute any more into your HSA at that point. I'm assuming you're going to be covered under Social Security and Medicare. We'll talk about that in a little bit. But you're able to use that HSA to pay for Medicare premiums and other costs. So right off the bat, with regards to the HSA, you should have a beneficiary on your HSA. You should elect a beneficiary. If it's a spouse, that spouse assumes the amount in the HSA, and there's no taxable event for that spouse. They're able to use the HSA just as they were able to prior. If it's a non-spouse, at that point, within 12 months, let's say it's a child who's the beneficiary on the account, they would just withdraw the money out of the HSA, and they would be taxed ordinary income on that amount. They would be able to, just one last thing, they would be able to continue to pay any expenses, for the deceased on a tax-free basis through that HSA. But after that, they would just take the money out of the HSA, close the account, and just pay ordinary tax on it.
Gotcha. So the account does still exist, though, if I leave my employer. It just is in my name. It's not actually attached to the employer.
No, it's not. That's why I said the portability of it. It's an individual account. You take that money with you, irrespective of the situation. It's the minute that money goes into that HSA, that's your money to use as you want. You take it, whether or not you go to another employer or you retire, it's your account, you use it. And also, if you're still HSA eligible, when you leave that employer, you're able to continue to contribute to it. If you're not, you just use it. You're able to make tax-free payments out of it. All right. So why the HSA matters? This is, again, talking about, now that we've looked at the basics of the HSA, this is talking about why it matters from the standpoint of today and in the future. So this is not a slide we have to spend too much time on. Everybody knows the rising healthcare costs, prescription drugs being a big driver in that. And so that's our challenge today. So that challenge is being seen by through surveys. This is a survey that looked at employees' viewpoints with regards to healthcare. 1 in 3 said they would forego a pay increase for better benefits for their family. 73% surveyed said they would be more motivated to stay with an employer based on health insurance options and benefits. So and there's not one right answer for everybody, right? It all depends on people's circumstances as to thing. But at the end of the day, healthcare costs or income, it's the same thing, right? It's money coming out of your pocket or going into your pocket. It's about how much you keep in your pocket, right? And so this is, again, just taking a comparison. This is the Kaiser Family Foundation looking at the annual premiums for a family plan, the PPO on the far right, we call it a PPO plan, that traditional plan, about $26,700, with the high deductible, $24,200. So you have about a 9-10% difference in the premiums. That's money that goes right into individuals and employers' pockets with regards to the savings from that high deductible health plan. And this is a this is a side by side comparison of the traditional plan, we call it a PPO in this case, and the high deductible health plan, that HSA qualified plan. Too many people, when they look, I joked earlier about the idea of the Marketing Hall of Fame, because when you do look at this, if you just look at that high deductible, you're always going to choose the traditional plan. But you really need to look at the full picture. So this is kind of a back of the envelope, if you will, look at how to work through that. So if you look on the left, you see under that traditional plan, the deductible is $1,800. The coinsurance is 15%. Out-of-pocket maximum $7,000. The premium's about $6,000, $6,100. The high deductible, you go from an $1,800 deductible to a $3,300 deductible. Your coinsurance is 5% higher at 20%. Out-of-pocket maximum is higher, and your premium is $4,056, and there's a HSA contribution of $1,000. Now, this is an actual company's offering with regard. This company has about 4,000 employees. This is their actual options for their employees. So if we look through that, if we go to the right and we look and we say, let's say we have $10,000 in expenses. We have $10,000 in expenses. With the traditional plan, we pay the first $1,800, leaving $8,200. With the high deductible, we pay the $33,000, leaving $67,000. We have another benefit with that traditional plan. We're only paying 15% of the coinsurance once that deductible is paid. Got to pay 20% with the high deductible. And then we figure out our premiums, our differences, and the fact that we do have $1,000 of a contribution because we chose the high deductible of that HSA eligible plan. Even at that $10,000, we're better off saying nothing about the tax advantages of the HSA, just looking at the two plans. We're still better off with that high deductible health plan. So am I saying that in all cases, in everyone's circumstances, everyone should choose the high deductible? I'm not saying that, but I'm saying here is the way to look at it and not just get stuck on that deductible. There's more to it. There's much more to the choice of which plan. So there's real savings associated with the high deductible that many people, depending on their circumstances, meaning if someone is chronic health issues and they've got a heavy prescription drug spend or something else, they might be better off with that traditional plan. But if not, really need to look at that high deductible health plan for that savings in today. And then looking at that maximum contribution for this year of $8,550, looking at the immediate savings using a 24% federal, 6% on the state tax. This is the state of Rhode Island where I'm located. And then that payroll tax, as I mentioned, the idea that if the money's paid through payroll, the 7.65% FICA, which is going to be on both, that $654 would be both for the individual and the employer. The savings just for that individual is $3,200. So if you combine the savings with the high deductible health plan plus the tax savings on your maximum contribution, and you just change these numbers if you're doing less than max, you can see where the HSA coupled with the high deductible can keep more money in a person's pocket today. And so looking at the future healthcare costs for retirement, the Fidelity each year comes out with an amount that they say a healthy 65-year-old couple will pay in retirement for healthcare costs. Many people unfortunately think all I've got to do is get to Medicare. When I get to Medicare, it's free sailing. It's not free sailing. There's actually costs associated with it. And according to Fidelity, over a long period of retirement, $315,000 is what a couple at age 65, retiring in 25, would be expected to pay.
Yeah, I also really love that slide, Matt, because I think it really shows how HSAs, can be utilized in more future think environments with, Medicare not covering everything. Again, that's one of those conceptions that I think people have, misconceptions that people have. But also that number is honestly really scary for a lot of people. And when we talk to people that are about to retire, one of the main things that we hear is a concern. And One of the things that I always like to mention about that number, because this is not the biggest, scariest number out there. As a reminder, this is for a couple, and these expenses don't hit day one of retirement. This is spread out over the long term of retirement. But we even see numbers higher than that. Like this is the amount for an individual potentially over, the time of retirement. And so I think it's so important to think about the HSA as a way to cover some of these costs, but also understand that, this is a really big part of that retirement plan picture and, putting all those pieces together and just a place that we see a lot of concern, for retirees.
Yeah, absolutely. I think it's a big number, and as you said, there are some bigger numbers out there. I think the idea is to be efficient with your plan for retirement. Your 401k is fantastic. No one's saying anything against the 401k. It's a powerful tool. What I'm saying with regards to the HSA, and I'll just show you in a second, is that the HSA for that portion of retirement that will be healthcare costs is the most efficient way to do it because it's tax free. And so we see that here. And again, this is just for perspective with regards to, this is just looking at federal tax. And the idea is like that 315,000, again, this is in theory, this is really just for concept purposes. That 315,000, if you have that money in HSA, that's what you need to have set aside for that cost. If you're using your 401k, you need more money for that because you do have to pay tax on that at some point, right? And so that's the idea. It's about being efficient for this cost, which is going to be one of the one of the big drivers in your cost on an annual basis in retirement. So there's the first part is just looking at you can pay it tax free or you can pay it after tax, so you get the savings there. But it's important to note that when it comes to Medicare Parts B and D are means tested. And so, and it's based on your modified adjusted gross income. There's these IRMAA surcharges. If you go over $1 in one, based on these categories you see here for 2025, you actually pay more money for your Medicare Part B and Part D premiums. So the concept is with regards to the HSA, if we look here, we have Rob, his income in this case, we have the $102,000. He takes $5,000 out of his 401k to help pay his expenses. His modified adjusted gross income is $107,000. Again, this is simplicity for, just for purposes of, to give people this understanding that that would put him into the first level of surcharges. So he's actually paying more for Medicare than he would because of these surcharges. So the idea is you can save money on Medicare by paying it tax-free, but that paying that tax-free and having that HSA set aside versus just taking everything out of the 401k can actually reduce how much you pay on top of it. So you get the savings of the taxes, but it could potentially save you money in how much you're actually paying for Part B and Part D. And so that Part B is for all your doctors and things like that. Part B is that, and Part D is prescription drugs. Long-term, I'm going to move along because I know we're getting tight on time. Long-term care costs are a big driver, obviously, in retirement. Long-term care insurance premiums are a qualified medical expense for individuals with an HSA based on their ages. These are the amounts in 2025. They will increase in 2026. And we just want to look at a couple quick strategies with regards to the flexibility of the HSA. So how do you build up this balance over time? If you want to take full advantage of your HSA, you're able to pay HSA eligible expenses out of pocket. Most providers have an electronic shoebox or whatever they call it, where you can save all your receipts. You can do that yourself. And the idea behind that is, listen, it's triple tax free. I'm going to let this grow tax free over time. Later on down the line, I'm able to take the money out on a tax free basis because I've already paid the expenses. So, but I want to build that balance up, and I want to build it up over time. And I realize in the example we have here, we have Jim puts he has $10,000 in expenses he paid out of pocket that were HSA eligible over time. He pulls down the line, takes the 10,000 because he wants to use it for a vacation. So you have that flexibility with the HSA. And that's, again, the idea is taking advantage of that triple tax free. And this is one that a lot of people don't realize is the fact that, as you know, up to 26, the Affordable Care Act, allows adult children to stay on their parents' health plan. So in this case, as I mentioned, anyone can contribute to an HSA. It can be an individual, the employer, or a parent even. In this case, we have Evan and Taylor, the 54. They're married. They have a 23-year-old son, Hayden. He's covered under a family plan. Okay. A couple things. He's not a dependent on his parents' returns, and he is covered under their plan. The maximum contribution for both the parents and for the son is the family maximum. So the son, even though he's an individual person, he's not married, it doesn't matter. The maximum contributions based on the type plan you're covered under, not your status. So there's a case where, again, if the son is in a position to max out, that's great on a family amount, but maybe the parents are able to help and put some money into an HSA to help build up a retirement or build up a cushion for him over time. And then the fast tracking of HSA eligibility. If you are eligible on December 1st, which just went by, if you're on that date, so let's say you even just got hired on December 1st and at the extreme, you're still able to make a full contribution for the year. You just have to remain HSA eligible for the next calendar year. So in this case, to fast track to get as much money in that HSA as possible, as long as you are eligible on December 1st, you can make the full contribution through the year, for that year, not a prorated amount. So that's a nice way to get a tax advantage on there. One other thing with regards to contributions, for this year, you're able to make your contribution for 2025 right up to the tax filing deadline in April of next year. So people who are in a position where they sit down with their accountant and they get that shock, I owe how much? Well, what can I do? Well, you can put more money into your HSA. And again, that's the flexibility of the HSA and how you use it. Okay. And Social Security and Medicare, I know we're growing tight on time. Most people in that right now, basically 70 who are going to be retiring. If you are enrolled in Social Security, you're not eligible to contribute more money into your HSA, because if you enroll in Social Security, you're automatically enrolled in Part A of Medicare. Any enrollment in Medicare will make you ineligible to contribute to an HSA. Now, you can continue to use your HSA to pay your expenses, but you just can't contribute any more money into the HSA. And so, I think one of the things with regards to the current utilization with regards to the HSA is that many people just don't really understand the situation that they're in with regards to the HSA, what they can do, the investments, why that's important. Too many people leave the money in cash, as you can see, whether it's $315,000 or whatever the dollar amount is, to be able to build this, just to leave it in cash is really, you're missing out, you're missing out in the long run with regards to these health savings accounts. So I'll throw it back to you, Brandon. I know that was a lot of information went through in a short period of time, and I speak quickly anyway with my Northeast accent, so I apologize to everybody. I hope I pronounced an R at some point during that presentation. Probably not, but as I said, it's important to understand the basics of the HSA and to also look at it as part of your saving money today. And if that's the way you need it, that's the way you should use it. But if you're able to build it up, it's a powerful tool for you in retirement as well.
Absolutely. And no, man, I think that was fantastic. It is a lot of information. And I think, when we were first, thinking about putting this together, I think it was interesting that I thought it would be a little more basic, and there are complexities to it if you use it in a creative way long term. And so those are the types of conversations that I think are important as we're, any of us are doing retirement planning or financial planning in general, to just get a better idea of how we're going to use every tool in our tool belt to get us to the financial outcomes we want. So if anyone has questions, I know we've had the Q&A, we've had some questions come in. We're going to do our best to answer those afterwards and reach out to you with some answers on those. The main thing I would say, if you do have questions about the actual intricacies of your plans, I think your HR representative, if you have a benefits broker that's available to you, can help answer some of those questions of, co-insurance requirements and all of that kind of stuff. But really, if you're thinking about this as a retirement savings vehicle, or how does it, interact with my Social Security, with my Medicare, as we're thinking about that as we're getting close to retirement. That's where we really want to help at Summit. We did start a Medicare division this year, so we're able to answer a lot of those questions on the Medicare side. And of course, financial planning and retirement planning, a major part of this discussions today. And I really hope that you all got some takeaways, not just on the basics of HSA, but how you can utilize them for your financial plan in the future. So again, thank you all for joining during such a busy time of the year. I've had a lot of attendance on this one, so I know that, again, it's top of mind for people. But please reach out to us if you do have any further questions. And I hope everyone has a Merry Christmas and Happy Holidays. Matthew, I'll turn it over to you.
Yeah, thanks so much, Brandon. We'd like to thank both Matt and Brandon for their time and sharing this informative and valuable information with us. And we'd also like to thank all of you for joining today's session. If you have any questions or would like to be connected to a resource here at Summit, please email wealthteam@yoursummit.com, as we'd be happy to assist and answer some of those additional questions that you guys had. And to look ahead, you can go ahead and mark your calendars for some of our next quarterly webinars, which first one was coming up on March 5th, 2026. And also feel free to follow us on social media, where we will continue to have legislative updates, tips and tricks, and things to help you pursue your retirement goals. As always, thank you all for joining us and letting us help you reach your summit. Thanks, everyone.